Hi, my name is Beall, and I did a three-company analysis using the Bloomberg lab at Southeastern Louisiana University. The three companies I chose to research were Rosetta Stone, Whole Foods Market, and Sanderson Farms. First company, Rosetta Stone, I looked at their quick ratio, which had a steady drop, which measures the dollar amount of liquid assets available for each dollar of current liabilities. Out of the three companies, Rosetta Stone has the second best 2014 and current quick ratio. Next, I looked at the current ratio and cash ratio. With the current ratio, mainly used to give an idea of the company's ability to pay back its short-term liabilities. As you can see below, a steady decrease from 1.78 to 0.88 from 2012 to 2014, and Rosetta Stone has the lowest current ratio out of the three companies. And with cash ratio, which is most commonly used by creditors when determining how much debt, if any, they would be willing to accept, steady decline from previous years and a very unattractive 2014 cash ratio at 0.35. Then I looked at return on equity and return on assets. Return on equity measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. A negative ROE simply means the company is not profitable at all. And as you can tell, from 2012 to 2014, Rosetta Stone has gone from negative 22.69 to negative 75.72. So it's not even close to being positive. And it's the worst out of the three companies. And return on assets gives an idea as to how efficient management is to using its assets to generate earnings. ROA tells you what earnings were generated from invested capital, and it's best to compare from previous years. And when you compare Rosetta Stone's previous years, they're all negative, but from 2012 to 2014, it's decreased over 60 points to negative 75.72. And the last time it was positive was in 2010 when it was only 5.29. And a negative ROA tells me that money being invested is not being generated into the company. In conclusion, Rosetta Stone appears to be struggling financially, and a lot of risk is involved when trying to invest in this company. I would not give a short-term loan, a long-term loan, or invest in this company simply because ROE and ROA are negative and the stock price shows no potential to increase anytime soon. From 2012 to 2014, however, they have been good at collecting money from sales, which is one positive to take into consideration in the future. The next company was Whole Foods Market, and I looked at same ones, quick ratio and current ratio. And out of the three companies, Whole Foods was the worst in 2014 and currently with quick ratio. It is not in a good liquidity position at all at 0.75, and its current ratio is the second best current ratio, but has declined in each of the last 4 years. I have listed 2012 to 2014, and it's decreased from 2.15 to 1.40. Cash ratio, again, steady decline in the last 4 years. Not a strong cash ratio at all. Compared to quick ratio, they are collecting money and getting paid though, which is good. 1.25 to 0.59. And then return on equity and return on assets, second best ROE, and it has increased each year, and it's a solid positive number. And second best ROA, and has increased each year. From previous years, management has efficiently used assets to generate earnings, which is always a good sign. And then price earnings ratio and current assets. The PE ratio has decreased, which means earnings over the last 12 months and before were at a high number per share. However, a high PE ratio suggests that investors are expecting higher growth in the future, and it is the highest PE ratio out of the three companies. And current assets, assets have decreased each year, but still at a solid number to pay outstanding debts and cover our liabilities without having to sell fixed assets, that's always good as well. In conclusion, since May of this year to now, stock has dropped over $11 per share. However, Whole Foods Market is still a financially stable company and a valuable option to have in your portfolio. At this time, I would give a short-term loan to Whole Foods Market because of the high volatility in stock price, and as of late has struggled with liquidity. Out of the three companies, it does pay the second best dividend return, and I would choose to also invest in this company because the ROE ratio is steadily increasing, and out of the three companies has the highest PE ratio, which to me means a future potential rise in stock price. Investing now could pay off in the long run. And finally, the last company I looked into was Sanderson Farms. Out of the three companies, statistically has the best quick ratio in the last 4 years. And compared to Rosetta Stone and Whole Foods Market, the current ratio is absolutely outstanding. And when looking at the cash ratio, it has the highest cash ratio, resulting in Sanderson Farm being the most liquid company out of the three currently. Return on equity and return on assets has the highest ROE, and by a very large margin, generates a lot of profit with money from investors. And return on assets has the highest ROA, which is an indicator that management has been efficient with using assets to generate earnings. Compared to previous years, the ROA has quadrupled, which is outstanding. It has the lowest PE ratio, and it has decreased each year. PE ratio is a good indicator of expected growth in the future. However, the lower the PE ratio, the less expected growth. It has the lowest PE ratio, so growth is not really going to be happening, I think, in the future. But you never know. And with current assets, has the second best current asset numbers. It has increased each year, meaning more profit is being made. Current assets are readily converted into cash to pay debts, and Sanderson Farms has the current assets to do so. In conclusion, stock price for Sanderson Farms is the highest out of the three companies with the second most volume. Since July of 2012, stock has risen over $50. The chicken industry obviously is very unpredictable, but recently has been doing very well since corn and soybean prices have been lowered. Since the market for chicken is high risk, I would give a short-term loan. I would also give a long-term loan because Sanderson Farms is a stable company and current assets have increased each year, as well as their current ratio and cash ratio have increased. I would also invest in Sanderson Farms because the ROE ratio has increased tremendously each year and is much higher than the other two companies. And finally, Sanderson Farms also pays out the highest dividends. In conclusion, this project gave me an insight of how to look at companies, and really it's going to prepare me well for the future. Thank you.